Hello and welcome. You're watching Money, Money, Money. I'm Samira Abdi. Now, most market experts are unanimous in the view that the equity market is set for much higher levels, and what we're seeing now is perhaps just the start of a much longer uptrend. As with most such uptrends, there are likely to be bouts of volatility, but the key is to remain invested over the long term. And the instrument of choice for retail investors, the balanced funds. That's the advice from our expert, Nimesh Shah, MD and CEO, ICICI Prudential AMC. And let me tell you why you should hang on to every word Nimesh is going to be saying today. Well, simply because he's overseeing about 1.3 lakh crore rupees as assets under management, and therefore would know the mind of the retail investor better than most. Also joining in today, keen to decode balanced funds, we have with us a Mumbai-based couple, Kalpana and Ravindra Pongshe. Thanks so much to all of you for being a part of our show today. We're going to be talking about balanced funds. So basically what balanced funds are, that they're a mix between equity and debt. So mostly, traditionally rather, equity have a larger allocation in balanced funds as opposed to debt. But Nimesh, the idea, theoretically I understand that it's a mix of both. But if the house view is that, there are much higher levels in store, that the market is going to go way higher from where it is, why not a pure equity fund? Why a balanced fund?
Actually, I'll step back slightly in the sense that you can have a view as a house, but it is ultimately the investor's risk appetite which decides where he wants to invest. Right, so a person may not have such an aggressive view. It can be that a person does not have that much of an aggressive view on the market, and he does not want that kind of volatility. So if you go for equity funds, yes, over a long period of time it can give you good returns, but it will increase the volatility also slightly. So if people want to reduce volatility out of their returns and they want a mix of investment into equity and debt, then theoretically I should invest 100% of my money in equity, right?
Sure.
But people don't do that. There are people like me who may be doing that, but there are others who don't want that kind of volatility, right? So they prefer to go debt. So balanced fund, what it tries to do, it gives some elements of equity, and it gives, say, 2/3 elements of equity. Around 70% is equity and 30% is in debt, so that the volatility is slightly reduced. So you may not get the entire upside of the market, but at the same time you don't get the entire downside of the market.
All right, so if then from a retail point of view, do I understand that balanced funds are just more conservative in their philosophy? So would that also mean that the equity component of a balanced fund would have a more conservative outlook, in the sense, would you only look at blue chips, or currently if the mid-cap rally is gathering steam, would you be a little more aggressive and look at stocks which would give you a higher potential of return?
Conservative is not always investing in blue chips, right? Say 1 year back, it depends on the situation of the market. 1 year back, the mid caps were being traded at a much lower value, lower PE than large caps. At that point of time, you could have increased mid cap, and that would also be a conservative strategy, right? Because you have gone and invested in stocks which are cheap. Right. So that's what. So it need not necessary that balance.
No, by
fund.
Conservative, I just mean safe. I mean stocks that you could, invest in and forget about.
Safe from the downside point of view also. If you go and invest, safe does not come out of the size of the company. Safe comes out of, if a very good big company is valued very highly, then it is not safe, because from the valuation point of view. So safety I would look at more from a valuation point of view than from the size of the company point of view. So there are lots of mid caps also which 1 year back looked much safer than the large caps, because their PE ratios were much lower.
I would like to ask you, what is the difference between balanced fund and balanced advantage fund?
We looked at what happens, what do retail investors do? We have always seen that retail investors come in when the markets have really gone up. They are not the first ones to come in. Sometimes they come in when a lot of rally has already happened in the market, because they look at past returns and come into the market. So we said, why can we have a fund which operates the way it should operate? Actually, to make money in the markets, you have to buy cheap and sell expensive.
Yes.
Retail sometimes does the other way around. They buy expensive and sell panic when it becomes cheap.
Yes.
So can we mirror some behavior in a fund which a retail is supposed to do? So please do not look at the markets. What we try to do, we brought in this idea of balance advantage, saying that the retail investor he invests when he has got money. So he should just come and put money in a fund called balance advantage fund. And what will we do for him? What will we do for him? That as the markets become cheap, we will invest more and more in equity. Say 1 year back, our allocation to equity would be much high. So we will invest percentage out of 100 rupees that you would have given me 1 year back. Say 70 rupees, 65 rupees I would have invested in equity, and 35 rupees I would have invested in debt.
Okay.
Today, I would have brought down my equity. When the markets have moved from 22 to 27, my equity would have gone down from 65% to around 40%. So it's a dynamic, we use slight jargon over here, we call it dynamic asset allocation. So there is a dynamic change between equity and debt based on certain ratios of the market. If the market looks expensive, we go for more debt. And so it is other way around of what the retail investor does. That's what we do in that.
But is there any ratio is varying, and who is monitoring that ratio?
So the ratio, there is an algorithm of price to book ratio at the Sensex level. So we look at the overall market levels. So based on the overall market levels, we have predetermined. It is predetermined. No emotions, no fund managers' views are involved. No emotions are involved. If the price to book ratio of the market becomes high, then we go more for debt. And if the price to become ratio, that is the advantage of a balance advantage fund.
Right.
And another thing is, I want to maintain equity taxation, because you have come in for an equity fund, so you need to have equity taxation. Yes. We always manage in that, the fund is always managed in a way that equity taxation status of the fund is maintained. At the same time, the risk levels are decided based on, so we call it a missile. We call it a missile which goes and seeks where there is less risk. If it sees that the market is less risky, it will go into that. It will always go into sectors which we believe at that point of time are lesser risky.
So the way we see it, your balanced advantage fund at least is, targeting the scores of people who are currently invested, or rather just saving in bank FDs. You're also giving out a monthly dividend on it. What's the rationale? Wouldn't you just prefer to have it reinvested in the plan?
Like, there are a lot of people, it depends on the person's requirement. If a person, suppose there is a school teacher who has retired and he has invested his money, so he wants some element of equity. If he wants some element of equity and he comes in balance advantage, still a retired person will need monthly income.
So why not
right?
an MIP?
We believe this is a MIP today with the new taxation laws will become taxable. Okay. It has got debt taxation. While in this one he will get equity taxation. So it is a superior product than MIP because it gets equity taxation.
So then do you think a balanced fund also satisfied a person's entire requirement of debt allocation in their portfolio, or would they need to supplement this with some other debt products?
Either you decide, if you can allocate on your own, you can say so much percentage is in equity, so much percentage is in debt, and you decide on your own. Otherwise, you leave it to us, come in a balanced fund category. If you come in a balanced fund category, you are very clear what is equity and what is debt. 70% is equity, and you tend to get the advantage of balanced funds is that your debt part, the debt kind of return also that you get is taxation-wise better off.
All right, so it works both ways, so you have like a dual advantage.
Right.
All right, on that note, we need to take a very quick break. We'll come back in a bit, but on the other side, we'll tell you what are the costs associated with a balanced fund and lots more. Do stay tuned.